upshot is that in a globalized world, the global policy mix matters and will likely matter more as our economies become more integrated.
This is why we can't have this one-size-fits-all regulatory approach. We need to look at the specific underlying features of the data.
From the 1990s on, the role of private capital has been more important, and that has had major consequences.
One of the dangers may be that reforms, if they come, are too little and too late.
Current accounts and exchange rates are not linked anymore. And I think that's the wrong conclusion to draw from these sorts of pictures.
The danger of excessive sanctions is that you are shooting the survivors of the crisis.
We have not yet addressed the fundamental issue of how much real economy debt the financial system helps generate and what types of debt.
I conclude that a global monetary order based on free floating is no more realistic than a return to Bretton Woods style.
So if you're a provider of the safe assets, you're going to have a huge demand from the rest of the world, and then you're going to end up with a very exposed external balance sheet. That's going to be an unpleasant situation. It could actually even lead to a situation where it threatens maybe your fiscal capacity.
Customer cannot be a provider of liquidity, it can only be a requester for liquidity, which lowers market efficiency.
The results of the UK referendum did not create a systemic failure. So our policies have been a very significant stabilizing factor in this situation. And without, say, the euro and the ECB, the situation certainly would have been worse in the first days.